Good morning, good morning. So we're picking up where we left off with chapter 6 on handout part 2. And last we left here, we talked about how we would look at the lower the cost or net realizable value, or sometimes it would be called market, depending on how they value the inventory, which costs they choose. And so we did it by individual and then major category and then total. And then we had the entry based on each category. And so now we're picking up with example 1, and I'm going to walk through that. So everybody please find that. If you didn't have a handout from last Thursday, that's where we're picking up. Guys, morning. Okay, so it asks us for each of these, determine the net realizable value for each item and the carrying value of each item under lower cost or net realizable value. So our cost for our skis is going to be $190, our boots $106, and our parkas $53. And we're just taking that from here. And then we have to calculate the net realizable value. And so what we have to do is we have to take the 212 selling price and subtract out the selling costs and the cost to complete. And so the net realizable value, essentially what you would earn on this going forward, would be $161. So your carrying value would then be the lesser of the two. And so in this case, 161 is less than 190, so it's 161. All right, I'm going to give you like 30 seconds. Try to calculate the net realizable value for boots. Okay, so we start with the selling price, 145. We subtract out the cost to sell. And then we subtract out the cost to complete. And I get 106. Oh, 108, thank you. And so here, our cost is lower, so our carrying value would be at 106. And the last one, parkas, 73.75 minus 2.5 minus 21.25. And I end up with 50. And so in this case, the parkas, the net realizable value is lower than cost, so we select $50. Any questions there? Okay, we're going to talk about inventory errors on the financial statements. Okay, so when we think about inventory, we think about an asset, and then once it gets sold, it becomes an expense. So it affects both the balance sheet and the income statement. And these are some of the ways that errors may occur. Your physical inventory on hand was miscounted. Costs were incorrectly assigned to inventory. Inventory in transit was incorrectly included or excluded from inventory, and consigned inventory was incorrectly included or excluded from inventory. So those are some of the errors. And the nice thing about inventory errors is that if they're genuine errors, they won't stay around forever. They'll reverse in the next year. But what happens is you have either overstated assets or understated assets, and as a result, you have income problems as well. But after 2 years, it's gone. So I don't want you to memorize these. Maybe 1 or 2 questions on the test about it. And so what I did was I just set these up for you so that you could easily kind of write them down and have a little study guide there to help you. All right. And so the effects of an understated inventory, and of course that means inventory is understated. And I want to go over to cost of goods sold and think about that. So if my inventory is understated, that means more expense flowed through cost of goods sold. Because when I do my formula for cost of goods sold, right, I subtract out the ending inventory. I keep putting these permanent markers next to the other ones. And then you end up with stuff like this. All right. And so remember to find our cost of goods sold, you have your beginning inventory plus your purchases minus your ending balance, and that equals your cost of goods sold, right? So if expenses are understated, cost of goods sold is going to be overstated. Now we have an expense that's overstated, and if we remember the way that our accounting function is, we have assets equal our liabilities plus our equity, and we remember that equity has kind of 4 parts. You have your paid in capital, which is like your stock and stuff like that. And then you have retained earnings, and then you have revenue, and then you have minus the expenses, right? So if revenues and expenses roll up into retained earnings, if expenses are overstated, then retained earnings is going to be understated because that's more expenses. Working capital is your current assets. And so since your inventory is understated, that is understated. Your current ratio is also understated. And your net income is understated. effects of overstated ending inventory. So now we're looking at sort of the opposite effect, and pretty much everything changes, right? Overstated. Overstated. Working capital is overstated. And your current ratio is overstated. Now, of course, the opposite effect happens with your expense, and that's understated. And that means your net income is overstated. Okay, this next part introduces purchases into this equation, because purchases can be input separately if there's an error, and so they can be understated as well as having the inventory understated, or they can be overstated. So of course, inventory is understated, as it said. Purchases are understated. For the cost of goods sold now, it's going to have no effect. And you say, well, why? And that's because we didn't put the purchase into the system. So the fact that it's understated doesn't cause any issues. And to retain earnings, no effect. Accounts payable is understated. Working capital has no effect. And the current ratio is overstated. Sorry. Yeah, I got that. Okay. Stated, good. Net income, no effect, right? Because it didn't affect cost of goods sold. And then your ending inventory is understated. Because we don't have the purchases in there. Essentially, what we've done is subtract out both the same amount here from both of these. So it was understated in both. And so the inventory actually works out okay because you're subtracting kind of the same amount from both. Now this would be overstated purchases and inventory. And so this is overstated. Retained earnings has no effect. Accounts payable would be overstated. Working capital would have no effect. And current ratio would be understated. Purchases, as we said, would be overstated. And cost of goods sold, there would be no effect. Net income, no effect. And inventory would be overstated. But because these are overstated equally, it doesn't affect the net income. Okay, so let's take a look at example number 1. Okay, it says Risers Inc. reported total assets of 2.4 million and net income of 320,000 for the current year. Risers determined that inventory was overstated by 24,000 at the beginning of the year This was not corrected. What is the corrected amount for total assets and for net income at the end of the year? So it says, for the current year, writers determined that inventory was overstated at the beginning of the year, right? And it says this was not corrected. What is the corrected amount for total assets and net income for the year? So this is at the end of the year, and so total assets is still going to be 2.4 million, because even though it was overstated initially, that's going to affect our net income. It's not going to affect our ending balance. And so cost of goods sold, or sorry, net income, now it's asking for 24,000 more cost of goods sold than it should. So add 24,000 to the 320,000, and that gives you 344,000. So the answer is B. Now you guys have a practice. I'll give you a minute and then we'll walk through it. Did anybody come in that needed a handout from last week? You're welcome. What's your guys' name? Okay, so let's take a look. It says if the beginning inventory for 2025 is overstated, so this is similar to what we just had, the effects of this error on cost of goods sold for 2025 net income and assets at December 36th respectively are, and so you have an trying to get the order right. Cost of goods sold, okay. So the error on the cost of goods sold is it's an overstatement, so we know it's either A or B. Net income, because it's overstated, gets understated. And assets at December 31st, 2006, there is no effect. So the answer is B. Okay, take a look at practice 2. Okay, if a company uses the periodic inventory system, which means they're updating it at the end of the period, whether that be month, quarter, usually annually, what is the impact on net income of including goods in transit, FOB shipping point in purchases, but not in ending inventory? So here we have slightly different case, right? Our purchases should be accurate because it's FOB shipping point, right? But we didn't include it in the inventory. And so here we understate net income. While you're looking at practice 3, I'm going to correct something. Okay. The failure to record a purchase of merchandise on account, even though the goods are properly included in the physical inventory results, is D, an understatement of liabilities and an overstatement of owner's equity. And so in the case there, you reported inventory, so it's going to be part of your assets, which boosts your equity, and you understated your liabilities, which also boosts your equity. When you think about here, your inventory went up, your liability stayed the same, your equity to have to go up. Any questions on those practice questions? Okay, you don't need to write all this out. I had intended to copy it over in your sheet. Unfortunately, I made a mistake and it looks like I duplicate copied from part 2. So take a line and just kind of cross that out and just note that it's reported in the other section. And that's on page 5, just under the bold, calculate inventory turnover and the number of days sales in inventory. And this just talks about what you have to report in the financial statements. Again, don't try to write all this out. You can copy it once I post it. And something similar should be in your text, but these are kind of my own notes. All right, so the basis for your inventory, we heard that called carrying value, book value. That means what is your inventory on your financials at? The method, we talked about the 4 methods: specific identification, FIFO, LIFO, weighted average, and the composition of inventory. So for manufacturers, work in process, finished goods, raw materials, they break those out. And then significant or unusual financial arrangements. I don't like the word significant. You know, material would probably be a better word there. Basically, if an investor, it's big enough for an investor to want to know, then you should disclose it if you have financing arrangements. Now, the stuff we got here for is to calculate and analyze inventory turnover and the number of days sales. And so we need pretty much just a couple formulas here, and they're fairly easy. And so inventory turnover, the formula for it equals your cost of goods sold. Spell that out, sorry. And that is divided by your average inventory. And this is the number of times on average a company sells its inventory during the period. The formula for average inventory equals your beginning inventory plus your ending inventory divided by 2. Right? Straightforward, basic average. You only have 2 things. You just take the basic average. And it doesn't matter whether or not they give it to you for a month or whether or not they give it to you for a year. You just take the beginning and ending. And then you have average days to sell inventory. And that will equal 365 or 360 divided by your inventory turnover. This measures the average number of days sales for which a company has inventory on hand. Now remember, I say 365 or 360. The problem should indicate it. If they don't use 365, but sometimes you'll see problems out there that use 360, and it's just so that it's easier to calculate than having to throw the 5 in there. 360 breaks up when you divide it by 12 months equally, which we all know doesn't happen. Someone's got to have 31. Someone's got to have 29 once in a while. Someone's got to have 28. Is there any questions on that handout? If not, I've got our in-class group work for chapter 6, and this will be, bless you, due by the end of class, and we'll see. I'll check where we are. If I need to roll it over to the next class, then I'll do that. But hopefully they won't. That's just some repetition, get you guys going. I'm gonna put that up, make sure it's on the site. Again, this is not a quiz or test, so if you have questions, please ask. This is a learning time. I think there's 3 there. Can you just send those down and I'll give you 2 more to send down. Thank you. So you were missed on pictures, and I think you're either Leo or Frederick. Federico? Yeah. Is it R, like F-E-D or F-R-E? So Federico. Right. And so remember, if you're working in a group, please only turn in 1. You guys can work together. And you don't have to turn in the questions, but you do want to make sure that you show your work. Good morning. Good morning. So these guys are pretty good to work with if you want to work with them. Okay. All right. This is Quincy and Josh, and that's Federico. He's going to come up and sit here. And for those of you that have your computer, if you want to do it on Excel and email it to me, that works as well. Okay, for those of you who are participating, I'm going to show you where this file is located. Make sure that I have it out there. So we just got to go to our Canvas site. Click on our class, click on assignments. And you'll find this one here. I'm going to go ahead and edit the due date. For those of you that are online, this will be due before the next class. And so these 5 questions are what we're working on for now. I'm going to pause the recording. If you guys have any questions, just type in the chat and I'll be more than happy to help. Okay, I'm just going to ask for your attention for 1 second. So the question may be a little bit hard to understand for number 4 and number 5. So where it says part B, apply the lower cost or market method to total inventory. What they mean is that you've got to multiply everything out, and what we're doing is we're just comparing the totals. So you're going to have to get the cost and the net realizable value and just compare their totals. Okay, so that's what it's asking for in part B. In part A, it's asking individually, and in part B, it's asking for the total. Okay, so I just want to let everybody know and everybody watching the video that that's what they're looking for.